Hello friends, today we are going to discuss about portfolio construction in pandemic times. These are really difficult times, and the question which comes to people's mind is how should one construct his portfolio, or where should you invest? Should you invest in fixed income, gold, real estate, or in equity markets? In normal times, there is low uncertainty. And when there is low uncertainty and stability in terms of your future, you are in a position to take high amount of risk. But during these times, when the risk-taking ability has come to the lowest level, most of the investors have become extremely risk-averse. One should follow few steps to invest your money. Step number one, which you should all keep in mind, that certain amount of money should be in bank fixed deposits or liquid funds, which are withdrawable at any point of time, and that should be equal to almost the next 6 months of your expenditure. So if your monthly expenditure is 50,000 rupees, then for next 6 months, which is 3 lakh rupees, you should have money in fixed deposit or liquid funds. Second step is that the money which you don't require for next 10 years, that money can go into equity market. These are really good times to invest in equity market, but don't go overboard, because one does not know how long this uncertainty is going to continue, what's going to be the extent of damage through this COVID problem, and so to that extent markets are going to remain volatile. So the money which you can invest for 10 years, it should be in equity markets. Step number 3 is at least 10 to 20% of your money should be invested in gold. It can be through physical gold, it can be through gold ETF, it can be through gold bonds, any of these options which you are comfortable with. And for the next 12 to 18 months, this is one class of asset which will do well, because there is high level of uncertainty and high level of risk aversion. So gold should be part of your portfolio. Step number 4 is that you should obviously not ignore fixed income market. And so in the fixed income market, you have the bond funds, you have the gilt funds, depending upon your time horizon. So whatever money which you don't require for next 2, 3, 5 years, that money can go into this fixed income market, can go into gilt funds, can go into hybrid funds, can go into bond funds. But depending upon your risk-taking ability, decide what is your extent of risk-taking, and then decide the quality of the portfolio and the kind of duration you like to invest. Now, the most important thing which you should remember in all these 4 steps while constructing your portfolio, that what is your risk-taking ability, and depending upon your risk-taking ability, the extent of diversification which you should do. Now, we have come across situations in the last few years, people have invested good amount of money in real estate and are stuck. Last 3 to 5 years, the real estate prices have not gone anywhere. And now going forward, probably for 1 or 3 years, the real estate prices will go nowhere. The second thing which you should all understand is that, you are stuck up in a lot of mid-cap and small-cap, companies. If the fundamentals are good and, the potential for the future growth is good enough, then you can hold on. But don't go into this habit of averaging further by investing more in that small and mid-cap companies, because you have invested and you have made a mistake and the stock is down by 50 to 60%, and you try to average it and thinking that you will get a return. So the most important thing is you are managing this portfolio in this difficult time till the time the vaccine is not discovered. These times are going to remain difficult, and so one should manage your portfolio with your risk-taking ability and the cash flow requirements. Thank you very much. All the best.